On the Monday, the previous daily high was tested right here, but we didn't get a clear break of that, and price made a new swing here. It pulled back and made a low here. In this video, I'm going to show you 3 essential checks that you can carry out to help you to avoid losing trades. Hello and welcome back to Mindfully Trading. My name is Emily, and on Mindfully Trading, I share my journey as I grow and develop as a Forex trader, as well as some educational tips and software along the way. I've been trading for over 5 years now, originally trading the stock market, and since then I've transitioned to trading Forex. I currently trade with the broker IC Markets, and I also trade with the prop firm, the 5%, who I'll talk about more a little later in the video. If you want to find out some more about either of those, there are some separate videos and also some links in the description below. Before we dive into the video, please remember to like, subscribe and comment below, and let's get straight to it. Tip number 1 is to consider the key daily levels. Now, the context of this tip will obviously depend on your personal trading strategy, whether you are a trend-based trader, a reversal trader, whether you scalp, whether you swing trade, whatever it is, keep it in context to how you trade. Personally, I tend to follow the trend and I stick to day trading. But regardless to what your strategy is, considering the daily levels is a key component of trading and can really help you to avoid taking any unnecessary losers. But just what exactly am I talking about when I say daily levels? Well, let's have a look on the computer. I've loaded up the chart here for Euro USD and I am on the daily time frame, the time frame that we are looking at for these daily levels. And there are a variety of points that you can use for daily levels, but the most basic ones that I use day to day in my trading are primarily the previous daily high and the previous daily low. Let's take this little area of the chart as an example. I think we can all agree that from the lows here, price has been pushing up. But what about this week? Well, this candle here is the Monday. Let's look at this week just gone, Monday to Friday. How can we use these key levels to help avoid taking losers? Well, they tell us a lot of information. First of all, we are in an uptrend, so naturally we are looking for longs in line with the overall market. On the Monday, the previous daily high was tested right here, but we didn't get a clear break of that. And Tuesday and Wednesday were basically the same. These are called inside bars. They didn't break the previous candlesticks. In fact, they didn't break the previous 2. They hadn't broken the Friday's high, which means that the start of this week for Euro USD, it was ranging. It was consolidating. It wasn't going up and it wasn't going down. And taking this simple bit of information into consideration, just using this key daily level here, can help to take any unnecessary trades during these days because they are inside days. There's no momentum, there's no volume, and so the chances of taking a losing trade are quite high because it is no man's land, it is choppy. However, as you can see here on the Thursday, we got a clear push above this key level here, which meant that there was probably some opportunity in there for intraday positions long and an increased chance of a win because momentum was on the side of the trader. The same can also be said in reverse if the market is in a downtrend. As you can see here now, going back in time on your USD, the market is trending lower. And so if we just take a section of this trend, let's look at this area right here. You can see that as price has been pulling back here, this most recent low is not broken on the Friday, Monday, Tuesday, or Wednesday. However, we got this huge momentum candlestick down here. On the Thursday, that key daily level was broken, and so it gave an opportunity for some shorts. The same would then apply from this point here, which gets broken, and then from there you are looking for a break of the next daily low. Other key daily levels can include significant points, significant swings using historical price data on the chart. So let me give you another example here. I've just zoomed in on pound dollar on the daily time frame, and let's just use this horizontal line to explore that concept. We had a push up and price made a new swing here. It pulled back and made a low here before pushing higher to make it all-time high here. And if we look and place this horizontal line on the low using the bodies, you can see that this was quite a significant area because although price broke it here, we got a retest of this level here. Price consolidated here, and we even got another tap and a retest, which was, it ended up being a year later here. So you can see how these areas can have a significant impact on price, and it can help you to plan whether there may be a magnetic attraction to these areas or a strong push away. And you can see this has another one here, this little swing high before the high here. We got a retest here, a retest and a close below before it swung down. But then recently we have indeed broken this. The chances of getting a pullback and a retest to this are quite high. But as we're trading, this is all speculation. There is no complete solid answer. These are just tools that you can use, you can add to your trading toolkit to help you along the way. Tip number 2 to consider to help you to reduce losing trades is recognizing the market phase. Now this is quite similar to my previous tip, but the previous tip focuses purely on the daily time frame. Recognizing the market phase can be carried out on any time frame, whether you are a long-term swing trader and you use the weekly time frame, or if you are a scalper and you use the 1 minute time frame. But what exactly do I mean by market phase? Well, again, let's have a look at the charts. I'm just going to draw out a really simplified version of a market phase here, and I think you guys can all agree that this is an uptrend. When price is doing this, we are going sideways, we are ranging or consolidating, and most of the time it'll either then go up or go down, and then probably form another pattern like this. And these are the 3 main market phases that you will find. Markets will either trend up, they will be going sideways, or they will be trending down. And knowing this simple fact can really help you to decipher whether a trade is a quality, whether it's worth taking or not. Because if you are a trend trader and the market is going up, then you know that that is a good sign and that you should take the trade. However, if you are trying to trade in a sideways moving market, in a ranging market, the chances are that you are more likely to take a loser because the overall market flow is against you. Let's put this into practice. So I've zoomed out here on the 15-minute time frame for Euro USD so that you can see each individual day this week, starting on Monday the 8th of July. Now this week I've been trading Euro USD and I have found it quite challenging, and that's because at the beginning of the week the market phase has been indeed ranging, and so there's been no volume, there's been no momentum. But how did I know that it's been ranging? Well, quite simply, I just zoomed out before the Monday and had a look, and you can see that we had been coming up in an uptrend, making higher highs and higher lows. Now the high of the previous week was this level here, and a significant low point would be considered this point here where this wick is. And from there you can see that during the Monday, the Tuesday and the Wednesday, price didn't break either of these 2 lines. It was ranging. And so trying to take any position for a short or for a long in this range just is not the best idea, because price isn't going anywhere. It can be far more sensible to wait for a clear break of a range, as you can see here, wait for a suitable entry before taking a position. And just to look at this further on a faster time frame, I've jumped onto the 1 minute, and this is just the current morning session here. You can see that the high of the session was this point here, the low was around about this point here, and most of the morning has been ranging in between these areas. We've got a little dip down here, but price came back up. It's only really when you get a clear break, such as you see here, that you can then consider looking for an entry. So it just helps to recognize what phase the market is in to clarify whether your trade idea is a quality or not. Finally, step number 3 that you can use to help avoid taking unnecessary losing trades is indeed to have a trading plan. If you've not already got a trading plan, I certainly recommend creating one, because it is essential to help guide you through the process of trading, to help decipher what is worth taking a trade on and what is not. In my opinion, a trading plan is essential, and if you haven't got one already, I've got a link below where you can download a free trading plan that I've created. It's a free template and it helps you to create your own trading plan. But what exactly is a trading plan? A trading plan is your roadmap to taking trades, and it includes everything that you need to consider as to whether this is a valid trade or whether it is a gamble. If you do not have a plan, if you do not have a specific set of rules that you follow to decide whether it is a valid trade or not, then you are most likely gambling. And these are the kind of points that you will find on a trading plan. You will have targets, you will have to consider your routine, But mainly you'll be looking at strategy, what time frame you use, any indicators that you use, what markets you trade, whether you stick to just Forex, and if so, what pairs they are, or whether you consider other markets such as cryptocurrency. You may also be looking at certain setups. You may have a reference to key levels that we talked about earlier in your plan. And then also there should essentially be a section on risk management. Risk is crucial to success as a trader. And these are just some simple examples of things that you can include in your trading plan. And as I said before, if you want a copy of this template, you can get one from my link in the description below this video. But they are my top 3 tips that you can use to help reduce your losers when trading. Success as a trader can simply come down to knowing when not to lose, to allow your winners to really run. And trust me, I've been trading a long time now. I have experienced many losers, and I know the importance of making sure that every trade that you take is A quality. As I mentioned at the beginning of this video, I currently trade with the 5%ers, who are a prop firm. If you're not sure what a prop firm is, there's a detailed description in this video that I will include above. But basically, a prop firm is a company where you trade the company's capital and any profits and losses are shared between you. The 5%ers have a few different programs available that you can choose depending on your own strategy that you use as a trader. I'm currently enrolled in the hyper growth program. And that's for a variety of reasons, mainly because it is very realistic. They have realistic targets and realistic rules to respect. For example, you cannot lose more than 6% of your account, and the valuation target is 10%. But what I really love about the 5%ers is that they have a 0 limit on time for actually carrying out the program. And this is rare. Most prop firms only give you a set amount of time, such as a month, to hit the challenge, which can make trading really stressful. And naturally, trading can be stressful enough. You don't want any extra pressure. If you feel that you're ready to have a go trading with a prop firm yourself, if you are consistently making profits, then I definitely recommend checking out the 5%ers. There's a link below in the description. Meanwhile, if you've enjoyed the video, please let me know by smashing the like button. Don't forget to subscribe to the channel, and I'll catch you in my next video. Thanks for watching. Bye.